All right, so we're diving deep into SBA loans today. We've got a ton of great resources to help us unpack all the details. We've got some expert insights from YouTube videos, articles breaking down the nitty-gritty, and even some official info straight from SBA.gov. By the time we're done here, you'll know everything you need to about SBA loans. Whether you're thinking about starting a business or just curious about this financing option, we've got you covered.
Think of it like we're giving you a treasure map to navigate this whole SBA world.
I like that. A treasure map. Okay, so first things first, what exactly is an SBA loan?
Yeah, that's where a lot of folks get a little confused. See, the SBA itself doesn't actually lend you the money directly. They're more like, I guess you could say like a trusted friend vouching for you. They guarantee a portion of that loan, which makes banks a little more willing to lend to small businesses, even if those businesses might seem a little bit risky on their own.
Oh, so it's kind of like having a cosigner with, like, amazing credit. That makes a lot more sense. Actually, one of the articles we found mentioned a flight school that used an SBA loan to buy several airplanes. I can't imagine a bank just jumping at that opportunity, without the SBA backing them up.
Exactly. And that's what's so great about SBA loans. They really open doors for so many different businesses. You might even be surprised who actually qualifies for one.
Yeah, I was thinking they'd be super exclusive, only for certain types of businesses. Yeah. But it turns out they're way more accessible than you might think, huh?
Definitely. As long as you've got a for-profit business that's based in the U.S., you're already on the right track. Then you've got to meet those SBA size standards, which, well, here's the kicker. Businesses with a net worth of up to $20 million can still qualify. Of course, you also need a solid business plan to show you're serious.
Hold on, wait a minute. So you can be worth millions and still be considered a small business by the SBA. That's a pretty sweet deal for some folks. But I bet your personal finances come into play too, right? Like your credit score and all that.
Absolutely. Your personal credit score is huge EE. Lenders look at it as a reflection of how you handle money, so a good score gives them more confidence that you'll manage the loan responsibly.
So it's like they're checking your financial track record, making sure you're a reliable borrower.
Yeah, that's a great way to put it. And one of the experts on YouTube actually shared a statistic that really hit this home. Businesses with those excellent credit scores, they often qualify for interest rates that are a full percentage point lower than those with not so great credit.
Well, that can make a huge difference over time. So before even thinking about applying for an SBA loan, it sounds like it's crucial to work on boosting that credit score, right?
I couldn't agree more. It's one of those proactive steps that can really pay off in the long run. Now let's get to the fun part, the exciting part. What can you actually use an SBA loan for? The options are surprisingly diverse.
I was blown away by all the possibilities. We found examples of everything from equipment to real estate to even acquiring an existing business or launching a brand new startup.
There's a ton of flexibility there. The articles highlighted examples of restaurants, retail stores, manufacturers, really, you name it. SBA loans can be tailored to a whole bunch of different industries.
That's interesting. I hadn't realized just how broad the scope was, but I imagine there's a catch, right? Like, don't you need a pretty hefty down payment?
You're definitely on the right track. That down payment is just the beginning, really. You see, there's this concept called post-closing liquidity that a lot of folks don't know about, and it often trips them up.
Post-closing liquidity. That sounds a little intimidating.
It's really not as complicated as it sounds. Lenders just want to see that you've got some cash reserves even after the loan closes, just in case unexpected expenses come up. They want to make sure you're prepared if there are bumps in the road.
So it's kind of like having a financial cushion to absorb those unexpected costs. Makes sense.
But how much are we talking about here? Like, what's a good ballpark figure? Well, a good rule of thumb is to have about 20% of the total loan amount ready to go, 10% for that down payment, and another 10% for the post-closing liquidity. Actually, one of the YouTube videos we watched included this really handy calculator. It helps you figure out exactly how much you might need for that post-closing liquidity. It takes into account things like your industry, the loan amount, all those factors.
Oh, that's awesome. I love tools that make those calculations a little bit easier. Okay, so we've got the down payment and the post-closing liquidity figured out. What else are lenders looking at when they're evaluating an SBA loan application?
Well, there's this thing called the debt service coverage ratio, or DSCR for short. It might sound a little technical, but it's really pretty simple once you break it down.
I'm all for demystifying financial jargon. Break it down for me.
Basically, it all comes down to proving to the lenders that your business can comfortably make enough money to cover those loan payments each month. They don't want you to be stretched too thin.
So it's kind of like a stress test for your business's finances.
Yeah, exactly. Let's say, for example, you're running a software company and your monthly loan payments are around $5,000. Lenders want to see that you're bringing in significantly more than that each month, ideally something like $6,250 or more. That'd give you a DSCR of 1.25, which is a good, healthy sign.
That makes sense. They want to see that you've got some wiggle room, that
Hmm.
you can handle those payments and still keep things running smoothly. I bet a lot of business owners, especially those who are just starting out, might struggle to hit that ideal ratio, though. Are there any strategies for, like, boosting your DSCR if you're not quite there yet?
That's a great question. And yeah, there are definitely things you can do. One approach is to really focus on increasing revenue. That could mean expanding your marketing efforts, maybe launching some new products or services, or even just streamlining your operations to make things more efficient.
So basically, finding ways to bring in more money each month. What about the other side of the equation? Can you improve your DSCR by reducing expenses?
Absolutely. Take a close look at your operating costs. See if there are any areas where you could maybe cut back without sacrificing quality. Maybe you could renegotiate with some suppliers, explore different marketing channels that are more cost effective, or even think about downsizing your office space if that makes sense for your business.
It sounds like improving your DSCR is all about finding that sweet spot between maximizing the money coming in and minimizing the money going out.
You got it. And don't forget, lenders often look at your personal finances too. They want to see that you're living within your means, managing your personal debt responsibly.
So it's not just about the business's financial health. Your personal financial habits matter too. It's all connected. Okay, so we've covered the key financial features lenders look at. What about the application process itself? Any tips for making sure everything goes smoothly?
One of the biggest things is to gather all the necessary documents early on. Don't wait till the last minute.
Good advice. What kind of documents are we talking about here?
You'll need your business plan, tax returns for the past few years, your financial statements, and projections for the future.
Sounds like a lot to keep track of.
It can be, but one of the YouTube experts recommended using a tool called Projection Hub. It helps you create those financial projections, which is important because lenders are going to be scrutinizing those very carefully, so you want to make sure they're accurate.
That's a great tip. Anything else we should keep in mind while we're preparing our application?
Don't underestimate the power of a good story. Your application isn't just about numbers. It's a chance to really tell your business's story. Explain why you're passionate about what you do.
So it's about bringing your business to life, making a personal connection with that lender.
Exactly. And remember, lenders are looking for reasons to say yes. So make it easy for them to see why your business is a worthy investment.
It sounds like preparation is key when it comes to SBA loans.
Oh, absolutely. And don't forget about choosing the right lender, too. It's not just about getting the lowest interest rate out there. It's about finding a lender who really gets your business, someone who's invested in your success.
It's more like finding a partner than just a loan provider.
Exactly. One of the YouTube videos we watched actually highlighted this tool, the SBA's Lender Match tool. It can help you connect with lenders who have experience working with businesses in your specific industry.
Oh, wow. That's like a matchmaking service, but for entrepreneurs and lenders.
That's a great way to put it.
I bet that takes a lot of the guesswork out of finding the right fit. We've talked a lot about the technical side of SBA loans, but I think there's a big psychological element to this whole process too. Applying for a loan, especially for your own business, could be pretty nerve-wracking.
You're absolutely right. It's a big step, and it's natural to feel some anxiety. One of the experts actually emphasized the importance of viewing the whole thing as a learning experience, even if you don't get approved the first time around.
So it's about embracing the journey, not getting discouraged by those setbacks.
Exactly. Each application is a chance to improve your business plan. You can strengthen your financial strategy and just build more resilience overall. And hey, don't forget about the power of mentorship. There are organizations like SCORE and small business development centers. They offer free guidance from experienced entrepreneurs who've already been through it all.
It's like having a seasoned guide to help you navigate that entrepreneurial jungle.
That's a perfect way to describe it. They can provide invaluable insights, connect you with the right resources, help you avoid some of those common pitfalls.
Man, I'm feeling inspired. There's so much support out there for small businesses.
There really is. And with the right preparation, the right mindset, and of course, the right support system, you can achieve anything you set your mind to.
Okay, so as we wrap things up here, what are some of the key takeaways we want to leave our listeners with today?
Well, I think the biggest takeaway is that SBA loans are a powerful tool for business growth. But they're not some kind of magic solution. It takes planning, preparation, and a willingness to learn and adapt as you go.
Couldn't have said it better myself. We've broken down all that complicated jargon, explored all the possibilities, and highlighted the key steps you need to take to be successful. Now it's time for our listeners to take all this knowledge and put it into action, whether that's checking their credit score, starting to save for a down payment, or maybe connecting with a mentor every step forward gets them closer to achieving those entrepreneurial dreams.
And remember, we're always here to cheer you on every step of the way.
That's right. Until next time, keep learning, keep growing, and keep that entrepreneurial spirit burning bright.